Hey guys, this is Mr. Roxy coming at you from West Palm Beach in Florida. It is March the 17th. It is about 5 p.m. It is still warm and sunny in Palm Beach. And you guys gave me some work to do. Specifically, a couple of you gave me an assignment to do to compare some midstream partners and pipelines and so on, one with the other. So I thought, you know what, let me take a few minutes and do this because by Friday I'm on the road again and I'm planning to be in Orlando for the weekend. Not on holiday to do some work. I'm not going to Disneyland or any Disney World or any of those things. I'm just going to work in Orlando. I'll be there on Friday, Saturday, Sunday. So I figured I better quickly get a couple of videos in and produce before I hit the road. Alexei in Moscow, I have not forgotten about you. I did pick up my copy of The Intelligent Investor today at my office in Palm Beach, and I will look at chapter 16 because you gave me an assignment to do as well. I'm not doing this assignment in this particular episode. You said I should look at chapter 16, which is convertible issues and warrants. So I picked up the Bible today. And guys, this is the investment Bible. If you want to read anything at all, you read this book. So Alexei, I'll take a look at chapter 16, refresh my memory, make myself some notes, share them with you, maybe at a later date. If I can do it before Friday, I will. Otherwise, just be patient because, as you know, if you give me homework, I tend to kind of do it. So anyway, I'm going to take a look at 5 different equities in this video. So stick with me and we'll take it from there. All right, guys. So as I mentioned, you gave me some homework to do. I'm going to pick just a few of the equities that you asked me to compare because I couldn't fit them all in. And it's very difficult to make one video on, many different types of equities, and certainly even in one particular sector like the energy sector. It's very tough to do a comparison of, more than 3 or 4 or 5 equities. But let's see how we go here. So just by way of a little bit of background, so I had a couple of people who said, hey, can you give us some information here? So Bulldogs said, Rudy would do a comparison of Midstream's ET, EPD, MMP, Enbridge, ENB, etc. I skipped Enbridge Bulldogs because I don't want to be biased. And I think by now, and most of you would know that I have a heavily weighted position in Enbridge. I like Enbridge, and I've been in that position for many years. So I kind of skipped that one. Eddie, I did add Marathon Petroleum. I'm not sure I'm going to answer your questions directly in terms of its acquisition and profitability. The disposition that they did of their convenience stores to 7-Eleven, that's happening later this quarter, to the Japanese owners of 7-Eleven. And Tim asked if I could add OKE to the list when I review the midstream. So what I did was I basically picked these 5, which is almost all of the ones that you asked me for, perhaps except for Bulldog's request for Enbridge as well. But if you do kind of what I'm doing here, you can probably just create your own little review. It's very easy. Most of this information is available via the web anyway. But what I did was I selected these 5. So as I mentioned just a minute ago, so Marathon, Oneok Inc., Energy Transfer, Magellan Midstream, and Enterprise Products Partners. And what I've done on every slide that I'm going to go through right now is I've just circled a few things which I'm looking for as, let's call them outliers for lack of a better term. So by way of example, on this first slide, I'm actually just looking at the price information of the 5 different equities. And I can see at a glance that Energy Transfer at $8 is really cheap compared to the others. And remember that a price of, in this case, $8 compared to another price of, let's say, $50 or so, doesn't mean Energy Transfer is cheap or inexpensive or a buy. It just means that your cost of entry is quite low because the price is actually quite low. It's better to look at the price earnings ratio to decide whether the stock is cheap, sort of figuratively speaking, at a quick glance, than what it is to look at the actual price of the equity in terms of what it's trading at on the market. Of course, if you wanted to buy 1,000 shares of Energy Transfer, it's only going to cost you $8,000 as an investment. Whereas if you bought 1,000 shares of, let's say, Marathon, it's going to cost you $55,000 as an investment, which may play a role or play a part in your decision. And that's why companies sometimes do a split or reverse split in order to make the price of their stock more attractive to investors. The other thing we can look at over here at the bottom of the screen, the volume. So you can see these two guys here, Enterprise Products Partners and Marathon. Almost 5 million shares traded, but look at Energy Transfer, almost 12 million shares traded, but obviously that's also a reflection of the actual price of the particular equity. So again, here we're looking at a couple of outliers or reasons for any particular reason why we should pay attention to the equity. I put a little description at the top of the page here for you if you want to know what alpha is, because I've circled a couple here with a weighted alpha. That's the investment strategy's ability, or your investment strategy's ability, to beat the market. In other words, it's excess or abnormal rate of return. Look at Marathon over here. By the way, the order is the same all the time. So if you look at the ticker symbol images at the bottom of the logo, it follows in the same sequence above it. So Marathon, and you can see that the weighted alpha here on Marathon is 166. Pretty good as well for OKE. And then you can see a little drop off here into single digits for the other three, but pretty good. The lowest one, 43%. So they all have a pretty good weighted alpha in terms of the equity's ability to beat the market. How about previous opinion? Now, you guys will know by now that I always say analyst schmanalyst. If anybody should be banned, it's not Dr. Seuss. It's actually analysts, because they impact the market and affect the market, and they always give you bad advice. Not all of them, but many of them do. Previous opinion. If we look at Energy Transfer here, so Energy Transfer is the one in the middle of the five. Last month, 64% of the analysts said buy it. This now is up to 88%. And how about Magellan? So 24% was saying it's a buy, now it's 88%. The others are fairly consistent, 100% buy, 100% buy. So analysts pretty much agree that all five of them are a buy, and all five of them are now pretty close to 100%, with Energy Transfer and Magellan each at 88. Let's take a quick look at this. The performance over the last couple of months or so. So over the last 5 days, I'm not too interested in, because it's very near term. Over the last 1 month, we can see Energy Transfer outperformed the others, up 18%, while the others were all in single digits, but still pretty good and positive. How about over the last 3 months? Marathon has outperformed all the others, up 38%, while the others were up either single digits, with the exception of Magellan, which was only pretty much flat over the last 3 months, which is kind of interesting, because most of the energy stocks have soared over the past few months. And how about over the past 6 months? So we can see Marathon and OKE in the 70s, mid to high 70s, while the others have given us a very good rate of return over the last 6 months. If we look at it on a graph, I'm talking about the 6-month period here. If you had been fortunate enough to invest MPC or OKE, you were up 75 or 80% respectively. And if you had invested in any of the other three, poor you, then you were only up 35, 23, or 39% over the last 6 months. You can put that in your pipe and smoke it. That's pretty good, right? Many stocks, including the FANG stocks, have gone down over the past 6 months or so. And year to date, Apple is kind of chugging along at about negative 9 or 10% or so. So the energy sector has served us pretty good and been kind to us over the last few months, after we endured all the pain and hardship of the early to mid 2020 season, when energy crashed to almost nothing. What I've done on this slide over here, guys, is I'm looking at the market cap, or the valuation, so market capitalization or valuation, as a percentage of annual sales. So just by way of example here, we can see that Marathon produces a mammoth almost $70 billion in sales, but its market cap is only 36 billion. So the reason for the way in which the number is written here is because annual sales is 69.7 billion, but the market cap is expressed in millions multiplied by 1,000. So right now, Marathon, this is as of today, March 17th, Marathon is has a market valuation of 36.6 billion, but it actually generates almost 2 times that much in terms of sales. So its market cap is only 50% of its sales. The opposite is true for OKE, because its market cap right now is actually 258% of its annual sales. Energy Transfer, much like Marathon, has a value of only 56% if you compare its almost $40 billion in sales to its market cap of around 20. The reverse is once again true for Magellan, which generates approximately 2.4 billion in sales, but has a market cap of over 10 billion, which means its market cap is 425% of its annual sales. And last but not least, Enterprise Product Partners has a market cap that is almost 2 times its annual sales. Down here at the bottom, it says 60-month beta, so that's a 5-year beta. Beta is the measure of the stock's volatility in relation to the overall market. We can see that the first three, MPC, OKE, and ET, are all 2 times more volatile than the market in general, whilst Magellan and Enterprise Products Partners is pretty much following the same volatility as the market as a whole. On this particular slide here, it says per share information and then ratios at the bottom. The only ratio I was interested in terms of this particular comparison was the price earnings ratio, which shows me that OKE with its current PE ratio of around 20 is just a little bit too rich for me to initiate a position in. As a general rule, I want to be at 15 or below in terms of making an entry. And the reason why I pick 15 or below is because that is the sort of average of the S&P 500 over the same period. So I want to definitely look at making an entry if I was to initiate a new position at around 15 or less. Of course, Marathon has a price earnings ratio which is non-existent because it was running at a loss. The other three all look like a potential entry point for me. So I took a quick snapshot of all 5 of them. I'm going to go quickly here. So I've just circled sort of 2 or 3 things on each slide just to kind of show you what attracts my attention. Right now, Marathon is trading at the 52-week high in terms of its range. This is not very unusual with the energy stocks. They've all bounced back. It has a nice chunky dividend of 4%, currently paying $2.32 on a stock that's trading at about $56. It's quite widely held by institutions at 72%, and the shorts are quite high at around 5%. Very quickly over here to OKE, I've just circled 2 things. Once again, it's trading at the high of its 52-week range, which, as I just said a minute ago, is not that unusual. But the PE ratio, as I explained a little earlier, is a little bit too rich for me at 37.5 times. For Energy Transfer, I have a nice dividend here again of 61 cents per share for on a stock that's trading at only $8. That gives you 7.5% on an annualized basis. It's not attracting too much attention from the institutions, which I actually like, and also not too much of a percentage of the float is short. Magellan, a couple of things here. The historic volatility is actually quite low. It's got a PE ratio, which is attractive to me right now, and a very rich dividend paying $4.11 on a stock of only $45, 9%, close to 10% dividend. Nice stock if you want to use it as a foundational stock. Right now, I have no idea whether they can afford to keep paying that dividend, but it's a really, really healthy dividend if that is what you're after. And then the last one, Enterprise Products Partners. A couple of things here. If volatility, again, 43%, not too volatile. The PE ratio is nice at around 14. A nice rich dividend, again, at $1.80 on a $23 stock, which is yielding about almost 8% per year, and also not attracting too much attention from the institutions. So guys, that's kind of a wrap on those 5 equities. You know, if you had to ask me, hey, Mr. Oxy, which one of those would you actually buy right now? Of the 5, the only one that I actually have a position in right now is Energy Transfer. I would add more to Energy Transfer. I opened the position that I have in Energy Transfer about a month ago, I think it was, maybe just a little more than a month ago, at $7. It's currently trading at about $8. After I opened the position at about $7, in fact, it was exactly $7, Energy Transfer dropped to like $6.30 or something in that next week, and then it bounced right back up to about $8 or so. I'm not too particularly concerned about the movements up and down. open that position in energy transfer because I had some cash that I wanted to park somewhere and it pays me a nice dividend. So that makes sense to me. I'm not sure if I would necessarily open a position in any of the other five. As I mentioned, OKE is probably a little bit too rich with its current PE. The other four look interesting, but of the other four, I already own one of them, so I'd probably be more inclined to add to my existing position on energy transfer than initiate something in the other four or three of them. Anyway, let me know in the comments what you think, and if you were to open a position in any one of these, which one would you pick? So I'm interested in your feedback, and I look forward to chatting with you. So thanks for watching. Take care. Have a great day, and I will talk to you soon. Bye bye.